Hi, I'm Steve Billimack, and I'm a partner in the Chicago office of Hightower Great Lakes. It's Friday morning, May 6th, 2022, and we wanted to take some time to give you an update on the markets in April and some of our thoughts. It's been a difficult first 4 months of the year, both for stocks and bonds. Both asset classes have sold off, and they've sold off in unison, which is fairly uncommon. The market hates uncertainty, and uncertainty has been rampant this year, whether it's uncertainty over the continuing COVID crisis, geopolitical uncertainty with respect to the Ukraine, inflation uncertainty with respect to the rate of inflation and how long it may last, as well as growth rates. And all of this is kind of shown up in the returns of both stocks and bonds this year. So let me share some charts with you to go through this. So the first chart looks at the S&P 500 year to date through May 5th. And you can see the trend is down. And what we had prior year lows in March, around March 14th, and then the market recovered. And what we've seen here in late April and even early May is the market retesting these March lows, which isn't uncommon. Usually, markets don't just do a V recovery; they tend to test prior lows, and so hopefully from here, we'll see the market improve. To put it in performance numbers, year to date, the S&P is down 12.9% and 8.7% in the month of April. Interesting on the large cap side, there's a bit of a difference between the different styles. So the Russell 1000 growth looks at the growth style, which has a lot of healthcare technology. That's been a very strong index the last few years. And so it's been a strong performer, but with rates coming up this year, some of those valuations are being tested, and the index is down 20% on the year or 12% in April. Again, even with this drawdown, when we look at it over the last 3 or 5 years, it's been a strong performing index, north of 16% annualized. The Russell 1000 value has actually performed on a relative basis better. That includes sectors like energy, materials, industrials. It's down 6% on the year, and most of that coming in April being down 5.6%. I mentioned both stocks and bonds are down this year. If we look at the aggregate bond index, which is kind of the core bond index, including U.S. Treasuries, investment grade corporates, agency bonds, that index is down 9.5% on the year and about 3.8% in April. And the reason for that is rates have been increasing. And when rates increase, the price of bonds goes down. And so if we look at the 10-year Treasury year to date, we started the year at about 1.6%, and the last few weeks we've been bouncing around the 3% level. So a doubling in rates. The only good news here is interest that's being paid off bonds, bond mutual funds is being reinvested at a higher rate. So again, that's kind of a quick overview on the performance. As far as some of the news that the markets have been digesting in late April 28th, the Commerce Department came out with the first quarter GDP number. It was expected to be up 1%. It was actually down 1.4%. And that caused market participants to worry about whether we may see a recession, because a recession is 2 quarters in a row of negative GDP. Hightower's chief investment strategist, Stephanie Link, doesn't think we'll see that. She noted that even in the first quarter numbers, both consumer and businesses were strong. Consumer spending was up 2.7%, and 4% on services, which is about 70% of consumer spending, and business spending was up 9%. So again, we're hopefully there's some trends forming underneath that will be viewed more favorably towards the end of the year. And really, as we look towards the end of 2022, we don't necessarily need good news. We just, the market can trade higher just with less uncertainty, and we are starting to see that. I mean, we're towards the end really of the first quarter earnings season, And so far it's kind of double-digit earnings, and no one sector is driving that. It's been fairly broad earnings growth. The other thing, many research analysts think that inflation peaked in March, and so even though we have higher inflation, hopefully the inflation will slowly decrease over time. So, as the market processes this, if it sees further proof of this may benefit the market. I think one of the big news items was actually the first week here in May. May 4th, the Federal Open Market Committee reported. Jerome Powell made some statements that helped clarify really the market's concern with respect to how they may be increasing rates and how they may be handling quantitative easing. The market, initially the Fed talked about inflation being transitory, and at this meeting they came out and they mentioned that they were adaptive to the current environment, which is a higher inflation environment. They did raise the Fed funds rate 50 basis points or 0.5%, and it's likely they're going to do the same in both June and July before they take a break from meetings in August. So we have some visibility there. They also provided some visibility on how they're going to unwind their quantitative easing. So starting June 1st, they're going to allow $95 billion a month to roll off their balance sheet, about $60 billion in treasuries, $35 billion in mortgage-backed securities. So again, just giving the market more information. Obviously the first week here in May, I mentioned, is still volatile. At the time of this recording, we're more or less flat on the week, but we did have some big drawdowns intraday, some big updates, some big down days. And so, at Hightower Great Lakes, we understand that this volatility can be uncomfortable, and we're here to talk about your portfolio and how it really is positioned relative to this market news or some of these trends. So thank you for taking the time to watch this video, and we greatly appreciate you being our clients. Have a great weekend.